But what would you expect to see happen to the bond market if at one point in history, more than ever before, every other asset class is liquidated and there's this mountain of money that needs to be parked somewhere for a brief period of time? What would you expect to see happen to the bond market? Absolutely explode, right? Let's have a look. Is that what happened? Absolutely. So the same time that the stock, the real estate, and the commodity markets are crashing, the bond market exploded. So now we know where the money went. It wasn't lost. It moved into the bond market. Now all you get is your money back with interest, right? But at the same time that happened, what happened to the interest rates around the world? They dropped to what level? The lowest levels ever. What was the interest rate in America? 0.25%. Still 0.25%. What about the UK? 0.25%. Europe? 0.5%. Canada? 0.25%. Japan? 0.1%. Australia? 3%. Okay? So that we have the highest interest rate of all the major nations around the world, but we had the lowest interest rate we've had in 55 years. But already we started putting our rates back up. We're at 3.75 now, but at that time we were getting 3%. Right? So how long do you think banks want to keep their money in the bond market getting the lowest interest rates in the history of the world? Not long at all. They want to move it back out of the bond market, back into the other markets. Now, what would be a clue to us? What would be a clue that the money's coming out of the bond market back into the other markets? Looking at that graph. Is when it falls, correct? Now, is that what happened? Let's have a look. Okay, so in January, February this year, money started to come out of the bond market. If we fast forward to today, you can see that the money's already come out of the bond market. Right? Actually, the bond market now is down below where it was before the crash last year. So the money's come out of bonds. Now, where did it go? Did it go back into real estate? Has the real estate market totally recovered? No, long time from that one. What about the stock market? Has that recovered? Starting to, right? But where did money go first? Into commodities. That's right. Okay, so let's have a look. Okay, we can see that the silver price exploded 110% this year. The copper price has been up 140%. Crude oil is up 156%. And these things haven't even recovered back to their highs, but they were so low they've been recovering percentage-wise an enormous amount. So we know where the money's gone. It's gone back into the commodities market. Now, the stock market, here's the S&P 500. It's up 65% so far this year. Right? Now, again, you can see it's got a long way to go to recover, but percentage-wise, it's up an enormous amount. Now, 65% on the total value of the whole market, that's huge. To put that into context, the last time the S&P 500 went up 65% like that was back between 1996 and 1998. And that was known as the tech boom. Right? And that took 18 months to happen. This time around, it's happened in 7 months. We are currently in the biggest stock market boom in the history of the world, and the media would have you believe we're still in a recession. Is that fair? All right. Actually, who's heard that the media has only just recently started to say, oh, you know what? It's actually not that bad. It's not as bad as we thought. Right? Who's heard the media is now sort of saying that, it's actually not as bad, it's actually starting to recover. Right? We've been in a recovery for 7 months. Is it fair to say that by the time the media is telling you something's happened, it's already happened? Right? So is the media there to teach you how to make money in the market? No. Okay, so you've got to know where the information is first, not wait for the media to tell you, so that you can see where the money's flowing. This is why, think of money like a balloon. Okay, so say you blew up a balloon. There's only a finite amount of money on the planet. Okay, and there's only about 4 different markets. So if you squeeze one market, the money's going to what? Bubble in another market, correct? And if you squeeze 3 of them, one of them's going to explode, correct? And when that one falls, it's got to pop up somewhere else, correct? So that's why we look at all 4 different markets, so that we can see where's the money going, so we can then stand there as the money's coming towards us, rather than be the sucker as the market's popping and all the money's moving out. Make sense? Okay. So we look at market fluctuations like our friend, not our enemy. All right? We like a volatile market. All right? So, because you can protect yourself if you get it wrong and make a big profit, whether the market's going up or going down. All right. See, a lot of people just trade the Australian stock market. Who here just trades the Australian stock market? People like that? All right. Now, no disrespect, and that's great you trade, but if you're just looking at the Australian stock market, frankly, you've got blinkers on. You're only looking at one little market. You're not seeing all the other markets that are going on, right? And you don't notice the freight train that's coming at you to the side of your head. I like to think, imagine yourself standing on the moon. Right, imagine looking back at the planet. What we like to do is look at the whole planet in total and look at all the money that's flowing around it from all the different markets to then work out what's actually going on globally. Does that make sense? Once you understand that, it makes it so much easier to see trends and then get into the market before the markets take off. All right, so like I said, I'm going to focus on the capital gain strategies, because the income strategies are very powerful as well, but there'll be other speakers today who teach you that particular strategy. So I'm going to teach you how to make a small amount of money into a much larger amount of money using capital gain. Now, when it comes to capital gain, the single most powerful instrument for making a capital gain is one thing called contracts for difference, or CFDs. Who's ever heard of CFDs before? Okay, it's easily the fastest growing segment of the money market in the world today. Now, in order to understand what a CFD is, let's assume that you believe a share price is going to go up. So if you think a share price is going to go up, what could you do to profit from that belief? You can buy shares, that's right. So you've bought the shares. Now, if you bought the shares, you'd have no leverage, would you? Because if the share price goes up 10%, you make 10%. Big deal, right? An alternative is you could buy what? You could buy an option. That's right, you could buy an option. You could buy a call option. What's the benefit of a call option? You get leverage, that's right. So you can control 10 times more shares than what your cash would normally allow. So if the share price goes up 10%, you make 100% profit. But one of the downsides with an option is that it's going to what? It's going to expire. What does that mean? That means when you buy your option, what do you have to do? You have to watch it, and sell it again, usually within a couple of days or a couple of weeks or a couple of months. Because if you don't sell your option before it expires, what happens? Boom, you lose all your money, correct? Okay, so options are really good for short-term traders. People want to watch the market very closely. But most people don't want to trade like that. Most people just want to buy shares and sit on them. Okay? So an alternative came into Australia about 8 years ago called CFDs, or contracts for difference. Now, CFDs are very, very similar to options, and then they give you about 10 times leverage. So therefore, if the share price goes up 10%, you make 100%. But one of the cool things about CFDs is that they do not what? They don't expire. And because they don't expire, what does that mean? That means you can buy your position and what? Sit on it. For how long? As long as you want. A year, a month, a decade, 20 years, longer. Okay? What's more, you can trade CFDs not just on shares, so, you know, Aussie shares like BHP or Rio Tinto or Lihir Gold, or American shares, Microsoft, Google, etc. But you can also trade CFDs on currencies. So you can buy, if you think the Aussie dollar is going to go up, you could buy CFDs on the Aussie dollar, have 10 times leverage, or US dollar. But you can also trade CFDs on commodities. Okay, things like oil and gas and silver and gold. Right? And I personally love trading commodities. Right? So I'm going to share with you today how to trade CFDs, particularly on commodities. So a CFD is so let me just finish that off, right? So for example, I'll give you oil as an example, right? Crude oil, easily the most heavily traded commodity on the planet. Now the crude oil price was trading up at $148 a barrel in August last year, the highest price ever it had been by far. It then crashed down to $32 a barrel by early this year. It's now rallied back up to just under $80 a barrel at the moment. So at the moment, it's about half of where it was last year at the high. Okay, but it's up from where it started this year. Okay, so who here thinks that the crude oil price is going to go up sometime in the future? Okay, who knows when it's going to go up? Nobody, okay? But who agrees that it will likely go up? Sometime in the next 3 months, 6 months, 12 months or beyond, it's going to rise in value. Okay, so what could you do to profit from that? You could buy CFDs on oil and what? Sit on it, right? How long can you sit on it for? As long as you like. Every 1% the price of oil goes up is a 10% return to you. Okay? So we'll talk more about oil later on. Now, a CFD is simply a contract between you and your CFD provider or your broker. There's lots of different brokers in Australia today. We use a group called Spectrum Live, but you're welcome to use whomever you like. Now, rather than actually buy the shares, we buy the contract for difference on the shares or the oil, for example. So you need to put up a 10% initial margin. So that means that, let's say you want to control $10,000 worth of shares or $10,000 worth of oil. Okay? So you don't put up the whole $10,000, you just put up how much? $1,000, that's right. You now control $10,000 worth of oil or shares, but you've only put up $1,000. So somebody has to actually come up with the cash to actually buy the shares or the oil, right? Because it's actually purchased in the market. Hey, we're not putting up the $10,000. Somebody else is. What do we call that somebody else who puts up the money? Liquidity provider. Well done. Okay. I told you it's not a hard seminar, is it? Okay. Liquidity provider. Now, who are the liquidity providers? The banks. Yes. Which bank? Well, that bank, okay? So Commonwealth Bank, National, so the domestic banks, but also the international banks. Okay, so HSBC, Deutsche Bank, the international and domestic banks, they will actually put up the cash to actually buy the position. So they're what we call the liquidity providers. Now, you personally, you never have a relationship with the banks. Okay, all you do is you simply open up your account with the broker. And the broker, all they ask you for is your name and address. They don't even ask you for any financial history. You could be bankrupted 22 times over. They don't care. They don't even ask. If you've got $1,000 in your account, bang, $10,000 will appear to trade. If you've got 10 grand in your account, bang, $100,000 will appear. Okay? Who's ever tried to buy property before and borrow money from the bank? Right? How much information does the bank want to know about you financially? They give you a financial enema. Right? They want to know everything. But when it comes to this market, they don't even ask. You could have 4 legs, no head, they don't care. All right? If you've got $1,000, bang, 10 grand appears. Right? They don't even ask the question. Okay, so you open up your account with the broker. The broker then deals with the liquidity provider. You just need to know if you put up $1,000, boom, money will appear in your account to do the trade. So the liquidity provider, they actually buy the shares, or they buy the oil. So we don't technically own it. They own it. We have the contract for difference on it, right? Which simply means that if the value of the shares or the oil goes up, we get the difference. If the value goes down, we are responsible for the difference. Okay? So if the price goes up, we make a profit. If the price goes down, we make a loss. That's right. So let's assume in this situation the price actually goes up by 10%. So let's say we've got $10,000 worth of shares. We've put up our $1,000. Let's say the price goes up by 10%. How much are the shares now worth? $11,000, right? So how much profit is in that trade? $1,000 profit. So if we now close out the trade, we get back our $1,000 margin and we get back the $1,000 profit. So what percentage return have we made? 100%. So even though the share price only went up 10%, we've made 100% profit. Okay, and this is simply what we call what? Leverage, right. And in this case, we have a 1-for-10 leverage ratio. Every 1% the share price goes up is a 10% profit to us. Easy. Okay. So what's in it for the bank? I mean, if we're going to make all the profit, what's in it for the bank? Interest, that's right. They're going to charge us interest on the money that we're borrowing to buy the shares. Okay? Now, the banks themselves, they don't even lend us their own money. What they do instead is they go and borrow the money from some other source. And they'll borrow the money from term deposits or superannuation funds or the Reserve Bank, and they'll pay what's called the annual cash rate or the LIBOR rate, so, which in America right now is 0.25%. In Australia, it's about 3.75%. Okay, so the bank goes and borrows the money from some source, pays the LIBOR rate, then adds on an extra piece of interest for themselves, commonly known as the haircut, right, which is about 2.5% interest, which is what the bank gets to keep for themselves. Right? So we're essentially paying the annual cash rate plus the bank's haircut. Okay? Now here is the Spectrum Live platform. This is the broker that we personally use. You can use them if you want yourself. All right, it's a brilliant service. You can download their software on your computer. It's free of charge. It gives you live streaming prices, news, and charts. It's really quite fantastic. But let's zoom in now for a moment to this particular window. This is the order pad for actually placing a trade. So here you can see I've typed in the code INTC. Now, what company does that stand for? Intel. Okay, what does Intel do? Makes computer chips, right. And where are they based? America. In America, that's right. So with Spectrum Live, you can trade both the Australian market, you can trade the US market. In fact, you can trade 21 different markets around the world. You can trade all throughout Asia, to the Kiwi market, the Canadian market, all throughout Europe. It's really quite fantastic. But you keep your money in whatever currency you want. So here in Australia, you keep your money in Australian dollars, in Australia, in the local bank here, right? You do not send your money overseas. You don't put it with an American broker. It stays in Australia, in a local bank, in Australian dollars, and yet we can still trade through one account all the international markets. It's quite fantastic. At some of the absolute cheapest prices of any broker in Australia. Okay? So broking has really moved on. If you're fairly, still using an older broker paying high brokerage, you really need to look at some other options that are available today. Anyway, coming back to this, I've decided to buy 500 shares of Intel. So I've typed in 500 CFDs. At the time I did this example, the share price was trading at exactly $20 a share. So 500 CFDs times $20 a share is $10,000 worth of Intel shares. But I, of course, don't put up $10,000. How much is the margin? $1,000. That's right. Okay. Now, the interest charge here was 88 cents per day. So how do they work out the interest? Well, if you're doing trades on the US market even though your money's in Australia, we do the trade on the US market, we pay the US cash rate plus the haircut. If you're trading the Australian market, you pay the Australian cash rate plus the haircut. Okay? Now, at the time I did this example, the US cash rate was 1% per year. What's happened to the cash rate since? It's gone down. That's right. But I'll leave the example at 1% because no doubt America will put their rates back up again sometime in the future. Okay, so at the time it was 1% plus the haircut meant we were paying 3.25% interest per year. Okay, so you take the whole $10,000 worth of shares, multiply by the interest rate, divided by 365 days of the year, comes out to 88 cents per day. Now you, of course, don't have to work that out. Right? The computer tells you straight away how much your interest is. Okay, but as an easy sort of rule of thumb, what I say is that for every $10,000 worth of shares you want to trade, you put up $1,000 or 10%, and it will cost you about $1 a day in interest. Okay, so you ask yourself, what can you buy for $1 a day? Nothing, right? All right. What about a bottle of water? How much are these days? Like $4, right? Who thinks that's the greatest scam on the planet? All right? Holy cow, $4, right? Okay, so next time you have a bottle of water, you could say to yourself, oh, I could have had $40,000 worth of oil in the market today. Instead I had a bottle of water. Maybe I should have had tap water. Okay. Now, the margin you'll see here is not a deposit. We are, in fact, borrowing the whole $10,000. So a little bit different. When you go to the bank to borrow money to buy a house, you put up a 10% deposit and you borrow 90% from the bank. Yeah? No, that's a different story here. In this situation, think of our margin like a rental bond. When you rent a house, you put up a 4-week bond. At the end of the lease, you get the bond back, right? It's the same thing here. We're putting up a 10% bond. We're borrowing the whole $10,000. Now, if the share price goes up and there's a profit, then we sell, we get back our bond, the margin, and we get the profit. If the share price goes down and there's a loss, our bond goes to cover the loss. So the banks are never at risk. So who's making money out of CFDs? The banks. Holy cow, what are the banks doing? The banks are borrowing other people's money, loaning it out to us, clipping the ticket, charging 2.5% interest per year on trillions of dollars with zero risk. Who'd like to be a bank? Earning 2% a year on trillions of dollars with zero risk? Fantastic. So who's heard that there's been banks all around the world losing billions of dollars in the last couple of years? Well, don't cry too much for them. All right? They might be losing a lot of money out of this pocket, but they're doing what? They're raking it into this pocket over here. Okay? Banks are very profitable at the moment. Okay, now, leverage. Leverage, of course, is a double-edged sword. What does that mean? That means if you get it right, you make an absolute fortune. But if the share price goes the other way, what happens? You can be filleted. Right? You can be absolutely filleted. Now, let us the share price fell by 10%. Okay, you got 10 grams worth of shares, share price falls by 10%. How much is shares now worth? $9,000, okay? So if you now close out the trade, the bank gets back $9,000, but they're owed 10. So where's the other $1,000 come from? Your margin, right? So how much of your margin have you lost? All of it. So even though the share price only went down 10%, you've lost how much? 100% of your money. So you've lost the whole lot. Ow. Right? What's more, here's a $1 million question. Can the share price fall more than 10%? Absolutely. How much did the market fall last year? 50%, right? Let's say the share price fell 20%. How much are the shares now worth? 8,000. So if you now close out, the bank gets back 8 grand, but they're owed 10. So what's happened to your $1,000 margin? It's gone. Plus what? You got to go find another $1,000 and lose that straight away too. So you end up losing 200% of your money. And how does that feel? Not too good. Okay. So is leverage something to be scared of? Should you not trade CFDs because you can lose more money than you put in? Should you not touch them at all? No. But should you respect and understand the leverage that you're using? Absolutely. Okay. Now, do you think there are people in our society who are attracted to the potentially huge returns of CFDs who don't consider the downside risks? Are there people like that? Sure. And what do we call those people? What do we call them? Men. Ladies always like that one, all right? Obviously, that's a generalization, right? I've seen some pretty crazy female traders too. But historically speaking, about 75% of people who trade CFDs happen to be men. Right? And it's wonderful to see so many ladies here too, but I'd still say that about 75% of people here are still men. And men tend to view the stock market like a physical challenge. I want to conquer the market. Right? Who can relate to this, right? You work at a company like BHP, and you say, oh, I'll buy the shares in BHP. It's a good company. I work there. I dig the holes. It's good. Right? And meanwhile, the share price is going down and down. And no, it's going to go up. It's good. And it keeps going down and down and down and down, right? Because men have to be right. Right? Women look at that and go, get out of it. Close out. Sell. Right? Who can relate to that as a guy? I definitely can. You hold on to trades that go against you. Okay. Warren Buffett puts it this way. I'm a huge student of Warren Buffett. Warren Buffett says that derivatives, which include options and CFDs, right, are financial weapons of mass destruction. Right? That used by people who know what they're doing can be used to create absolutely fantastic wealth, as I've demonstrated to you already. Right? Used by people who don't know what they're doing, the uninitiated, the uneducated, the plain stupid and greedy, right? You can absolutely destroy your account. You can lose all your money and multiple times they're over. Okay, so if you're not going to go to the effort to learn how to use these things properly, don't trade them. But if you're going to go to the effort to learn it, they're fantastic when you know what you're doing and you know how to protect yourself. They're by far what I consider the most powerful wealth creation strategies on the planet. And frankly, I'd love to see someone show me, if I could challenge anyone to show me a better strategy, because I've never seen it, and I would love to. All right, now let me ask you a question. What is the single most important thing to becoming a successful trader? Is making a huge profit the single most important thing? No. Mindset, not so much mindset to a degree, but there's one thing particularly. To become a successful trader, the most important thing is to what? Is protect your money. Right? Is to protect your money. Right? You said that, didn't you, sir? Well done, sir. Ready? There you go, mate. Well done. Excellent, right? Protecting your money. Right? How you protect your money will determine ultimately how successful a trader you'll become. Okay. Who's here has ever gone through a dark time in their life? All right, we've all gone through a dark time, right? We've lost money, we've lost a loved one, or we lost a job, whatever, right? It's how you handle yourself in the dark time that determines who you are as a person. Is that fair? Anyone can handle the good times. It's how you handle the down times that determines who you are. It's the same thing with trading. Anyone can handle the profit. That's the easy part, right? It's how you handle your losses that determines how successful you'll ultimately be. Okay? Now, Warren Buffett again puts it this way. He says there's only 2 rules to becoming a successful trader. That's it, only 2 rules. What's rule number 1? Never lose money. What's rule number 2? Never forget rule number 1. Easy. Now that sounds incredibly what? Obvious, right? Obvious and simple. But the reality is 99% of people who trade do not follow these rules, even including institutions and fund managers. All right. Let me ask, who here trades? Who's ever traded before? Stocks or options or anything? Okay. What's the thing you normally use to protect your downside risk? A stop loss, right. So who's ever heard of a stop loss before? All right, most of you. Okay, what's a stop loss? A stop loss is simply an order that you give to your broker that says, if the share price falls to this level, bang, close out my trade, sell, stop the loss. Make sense? So for example, let's say you bought your shares at $10 and you put your stop loss down at $9.50, which is about 5% below the purchase price. And so if the share price hits $9.50, bang, automatically the computer closes out the trade and you cut your loss, you stop your loss. Now, if the share price has fallen 5%, how much of your money have you lost on the CFD? 50%, right? Why? Because you got a 10 times leverage. Okay. So here's your strategy for getting out of your trade, losing 50% of your money. Is that following rule number 1? What was rule number 1? Never lose money. It wasn't never lose money. Up to 50% is okay. What did it say? Never lose money. Okay. So what some people say is, let's put our stop loss down at 2%. That's better. Now if it's a stop loss, only lose how much? 20%. That's better. You're still losing money, but at least it's not as 50%. But what's the problem with having a 2% stop loss? It's too tight. Right? It's too tight. Right? The market's fluctuating during the day. It can easily come down, hit your stop loss, close you out for a loss, and then what? Bounce back up again. Who's ever been stopped out of their trade before? Oh! Don't you hate that? Because you're doing everything right. You're on a winning trade. You should have made a profit, but just for a minute. It comes down, hits your stop loss, closes you up for a loss, and then despite you, does what? Bounces back up again. Oh, I hate that. So some people say, let's put our stop loss down at 10%. Now we're not going to get stopped out as much. But what's the problem with the 10% stop loss? You're not really stopping the loss. You've lost everything at that point. So where's the happy balance? Around 5%. That's why most people put a 5% stop loss. But the reality is you're still losing 50%, aren't you? What's more, you might buy your shares at $10, put your stop loss at $9.50, but can the share price gap? Can it open lower the next day? It might open down at $9, right? So you could end up losing 100% or more, even though you're only prepared to lose 50%, correct? Okay, so obviously there has to be a better way, right? And can I get a handheld mic? Can someone get me a handheld mic, please? All right, there has to be a better way, okay? And there is. In fact, how many people here have seen me speak before? All right, I recognize a couple of familiar faces, just down here, thanks, hands. Right, so what we're going to focus on is we can buy, in fact, you guys tell me, what can we buy to guarantee us the right to be able to sell our shares for the purchase price of buying them? What can we buy? Okay, insurance, well, what do we call that, a put option, right? We can buy a put option. Who's ever heard of put options before? Right, who's never heard of put options before? Who's heard of them but doesn't really know what they are? Right, okay, cool. So, what an option is simply the right to buy or sell a parcel of shares at a set price on or before a set date in the future. Now, there's two different types of options. What are the two different types? Calls and puts. Right. So a call option gives you the right to buy shares, and a put option gives you the right to sell shares. Excellent. Okay. Now, how many people here... Well, I'm going to speak now to the people who haven't seen me speak before. Okay, because if you've seen me speak before, you kind of know where I'm going with this, all right? So I'm now speaking to people who haven't seen me speak before. So of all those people who haven't seen me speak before, how many people here own a car? Okay? Now, who insures their car? All right? And who has never traded options before? So Freddie owns a car, insures a car, and hasn't really traded options before much. Okay, great. I'm going to pick on you, sir, only because you were being a bit loud before as well, okay? So you look like a bit of fun. All right. Now, what's your name, sir?
Simon.
Simon. Okay, cool, Simon. And Simon, you own a car?
Yes.
And you insure your car?
Yes.
And you've never traded options before?
That's right.
Brilliant. But you want to learn?
Yes.
Excellent. Okay. Now, Simon, do you crash your car every year?
No.
No. Have you ever crashed your car?
Yes.
Yeah. How long ago?
Years ago.
Years ago. Okay. So how much insurance do you pay?
$80 a month.
Okay. So what's it? 900? Almost call it $1,000 a year, right? For a round figure. Okay, $1,000 a year. All right. And do you mind if I ask you how much is your car worth?
They say it's worth about $6,900.
Oh, really? Okay, so you're paying around about 15% of the value of your car in car insurance every year, right? How old are you?
22.
You had to think about that one, didn't you? All right. 22. Well, that's why you pay so much car insurance, okay? So a 22-year-old guy, obviously his insurance can be a bit more expensive. Most people in Australia pay somewhere between about 5 to 10% of the value of their car in car insurance. Okay, you young guy, you've already had a car. You're only 22, you've already had a car accident, for crying out loud. No wonder you pay $1,000 a year. Okay, so... Simon, all right. Now, but you haven't crashed your car recently?
No.
Long time. Okay. Now, Simon, if you don't crash your car, so at the end of the year, the car's totally fine, no one's crashed